Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500. All eyes are on the SP 500 as the battle between bears looking for a 50% drop in the market and bulls looking for the market to hold this 3,900 point level and potentially moving higher. We've recently had the first negative earnings revisions that began in August, right? These are SP 500 earnings revisions. While you can see we had a boom in earnings throughout 2020 and 2021, we are now seeing earnings revisions drop back down into negative territory. So at first glance, we do have this very scary picture on the SP 500 where earnings revisions are being made to the downside. Analysts are getting pessimistic on SP 500 earnings. And of course, we have a Federal Reserve that is committed to raising rates in order to cool down the economy, lower inflation, and pulling down stock market valuations. So that's a very scary macro picture where you understand why a lot of people are very pessimistic on the market right now. You've got the VIX right now, so the volatility index of the SP 500, that's kind of in no man's land. It's not at support, it's not at resistance, it doesn't give any objective bias. So bearish investors, bearish traders could argue that the VIX should be rising to the top of this triangle consolidation pattern up to this line of resistance and then potentially even breaking out and going into that capitulation area at 46 that has historically captured the major market bottoms throughout history. And I am talking about September 1998, August of 2002, June 2010, September 2011. All of these were capitulation events where the VIX reached 46, which has not been the case yet. And if we quickly dive into the technical picture on the S&P 500 here, seeing what's going on throughout the day, first of all, we have this head and shoulder pattern that played out beautifully, almost to the dot. The target was hit at around 3,900 points, hitting this trend line. Market is now reacting to that support level with bullish divergences in place, with the price going down to support and the RSI moving higher. Technicals aren't everything in the market, but bullish divergences are an indication of a trend change, at least in the short term on this 8-hour chart. Previous bullish divergences on the 8-hour time frame on the S&P 500 have led to counter trend rallies. Now, some of them have failed, and that's something to keep in mind. If we see these bullish divergences fail, right, like they did, for example, in May here, triggered a nice bounce, but it was immediately sold into, that is what I consider a failed bullish setup, a failed bullish divergence setup. And you can see here the divergences that were building throughout that period. The market was rejected at the 38.2 retracement level. If we see that type of move with the market getting rejected very rapidly here and then selling off, that is a big warning signal, right? That type of setup, failed divergence, if that were to occur, you'd probably see the breakdown of the 3,900 point leading to a much deeper sell-off in the market. But obviously that hasn't happened yet. For now, it's bullish divergence. The last time we saw that was right here in June of 2022, leading to that big rally. Before that, it was the rally in May, also very powerful, 5 to 6% move up, 5 to 6% move up. That could potentially take us back to the zone of resistance at around 4,100 points. So with that technical structure giving you context as we're going throughout this video, we're going to dive into what's going on underneath the surface, what is driving this market right now, and where should we expect it to go next. If you are interested in following these crazy markets with us, make sure to smash that subscribe button. If you are new here, don't forget to click on that subscribe button. We post these videos multiple times a week covering what's going on in the market, ranging from technical analysis, sentiment analysis, internal market dynamics, and learning how to take advantage of those opportunities. Now, without further ado, let's get right into it. So the first dynamic that I want to show you in this video is how close the S&P 500 has been trading against the 10-year yield. And I'm going to quickly show you that because this is a dynamic that we've talked about before, the importance of paying attention to yields in the current market environment. You can see a large part of the initial move down in 2022 was fueled by the bond market. So yields moving higher in a big way. Now, of course, this was fueled by an aggressive Federal Reserve, but you can see since the top in the 10-year yield, we've had a bottom in the market. The 10-year has not revisited that top, right? It's not yet back to its highs, and the market is not yet back to its lows. And if you want to see how crazy this relationship is on the 10-year yield, here I've put the inverse of the 10-year yield just to show you what that looks like. And you can see, especially recently here, you have a move up here on the inverse 10-year yield. That leads to a move up in the market. Move down in the inverse 10-year yield, move down in the market. Move up in the inverse 10-year yield, move up in the market. Move down in the 10-year yield and move down in the market. In fact, in hindsight, you can say that this rally here back in March, where the market was moving higher very, very aggressively, despite the 10-year yield going in the opposite direction, that was such a beautiful moment to be de-risking and adapting to the rising yield environment. Can we say the same thing about the market today? I'm not sure we can. Right here, the 10-year yield was in this aggressive trend, taking out its previous highs, while today the 10-year yield hasn't yet taken its previous high. So while a lot of people are saying that the stock market is not connected to reality, it's not in line with what the Federal Reserve is saying, right? Because the Fed has been very hawkish recently, reaffirming their fight against inflation. And so a lot of people are arguing that the market should be a lot lower here, but it doesn't seem like the 10-year yield currently agrees with that. Now, this is exactly the type of market analysis and research that we put out on gameoftrades.net. The idea behind this is to give you an education on how market dynamics work, what influences the market right now, highlights opportunities when they arise in the market, but most importantly, it helps you keep in check with your emotions. Stay away from fear, stay away from greed. That's one of the core goals that we have at Game of Trades, is to help investors stay away from those emotions that can completely wreck returns. If you're FOMOing at the top or panic selling at the bottom, that can be absolutely devastating. You are going to get crushed by volatility. You're going to get caught up when you get optimistic and incredibly scared when the market is down, not being able to visualize what a brighter future looks like when the market is down and what a correction can look like when the market is up. To us, that is the number one biggest problem amongst individual investors. And one of our key goals is to make sure that your emotions remain stable. When the market is overheated, we want to talk about the negatives. We want to post lower support levels, lower entry points, and when the market is oversold, that's when we talk about those bigger targets. Back in June, right here, at the very bottom of this correction, we highlighted one of the most oversold readings in stock market history, with SP500 stocks above their 50-day moving average being below 2% for the first time since COVID, and before that it was October of 2008, which happened to be two of the most attractive buying opportunities in the last 2 decades. And then as the market rallied to that resistance, to the trendline resistance, after 19% move up in the market, we highlighted the VIX that was at support, the RSI that was overbought, and that had triggered other similar market tops. And we highlighted the 3 key levels of support that could hold the market in the event of a correction, including 3,900 points, which is where the market is currently standing today. So if you want that kind of service that provides a contrarian outlook in the market and hopefully makes you understand the risk reward to a full extent, we do have a free trial that you can check out, test out our service for 7 days, and hopefully join our growing community of investors. So a lot of people are arguing that the market should be a lot lower here, but it doesn't seem like the 10-year yield currently agrees with that. Let's take a look at the 10-year yield right now, the actual chart of the 10-year yield. For now, at least for now, it seems like it wants to make a lower high. It has quite the same momentum as it did in March, April of 2022. If we take a look at the weekly chart and the MACD, we're still in bearish momentum here. If we take a look at the weekly chart, the longer term chart on the 10-year yield, we have this beautiful long-term trend line resistance here that captures a lot of the tops on the 10-year yield. A huge number of reactions, and we're currently trending right around it. It got rejected once in June, and now it's retesting that trend line. Now, if you see a bullish crossover here on the MACD, you see the 10-year taking out that previous high, then you should expect the stock market to be doing the same thing, right? Panic in the bond market with yields rising should trigger a panic in the stock market as well, or at least that's what the current market dynamics are suggesting. Now, from the research that we've made, we don't think that's very likely. Now, could we see a slight overshoot of the high before yields reverse? That's very possible. But ultimately, we think looking forward in the next few months, inflation will start to be a real drag for yields. It's going to start to pull a lot of downwards pressure on yields, very similar to how higher than expected inflationary numbers in 2021 right here. When the Fed's war against inflation really started, the market started to pay attention to inflationary numbers. And so every time you got a bad reading, the 10-year yield would go on a big run. The last time that happened, if you remember, was actually right here in June when we got the May CPI reading that came in at 8.5%, I believe. It was released right here on the 10th of June. And look at what happened to the 10-year yield. It triggered this massive move up, this 15% move up just in a few days. Now, if we start to see some lower than expected inflationary readings, which is what we think is going to happen over the next few months, you should start to see the very opposite process begin to occur, where the 10-year yield is going to see a significant amount of easing, and the bond market would start to price in significantly looser conditions in the future. If you take a look at the relationship with the stock market, this type of move on the bond market could trigger this type of move on the stock market. Now, of course, that's hypothetical. We're just paying attention to the market dynamics here, and they're clearly not always perfect. And a good example of that is this rally in March, where the stock market rallied very aggressively despite the 10-year yield pricing in very, very tight conditions. And that can happen in the opposite direction, right? If you have a panic move down, the market loses important technical structures at around 3,900 points, you could see a capitulation event despite the bond market moving lower. Right, that could happen, and actually in the event where that does happen, that would provide the most beautiful buying opportunity in the market. We'd have incredibly high conviction in that type of scenario. It would actually look quite similar to what happened in this period right here, where the bond market was clearly a source of volatility in the markets, right? 10-year yield was rising, the stock market was falling. 10-year yield rising here, stock market falling. But you can see during this capitulation event, the stock market broke down below its support. You had a margin call panic here throughout the month of December, despite the fact that yields were telling you that conditions were easing. Now, of course, inflation, yields, the Fed, that's only really half of the story of the stock market, right? Because that's what we're trying to figure out. The stock market is based off valuations and earnings. And so if earnings are collapsing, as we talked about in the beginning of this video, that is going to put pressure on the stock market. We're going to be posting an in-depth article on earnings today, highlighting whether or not we should expect an earnings collapse. And if we take a look at recent history, the worst bear markets have been caused by earnings collapse. So we need to figure out whether that's a risk today. Right, we've had the Fed tighten significantly. A lot of people are talking about the fact that that's going to lead to a bear market imminently. So that's a question that we need to take seriously. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.